Find out what your policy would sell for before you surrender it. Surrendering typically pays 3 to 5% of the death benefit, while in 2025, the average life settlement paid nearly 9 times the average surrender value. Both paths end the same way. You stop paying premiums and walk away with cash, so the only real question is, how much? Here's what each one pays, why the gap is so wide, how they are taxed, and when surrendering is the better move. Start with the surrender. You tell your insurance company to cancel the policy, and it pays you the cash surrender value. The cash built up inside the contract, minus any surrender charges, minus any loan against it. Surrender charges are common in the first 10 to 15 years and shrink as the policy ages. The result usually lands around 3 to 5% of the death benefit. On a $500,000 policy, that is often $15,000 to $25,000. And term insurance builds no cash value, so surrendering a term policy pays nothing. Now the sale. In a life settlement, you sell the policy to a licensed institutional buyer instead of handing it back to your insurer. The buyer takes over the premiums and collects the death benefit later, and you take a lump sum now. Policies that qualify typically sell for 10 to 25% of the face value, roughly 20% on average. On that same $500,000 policy, that is $50,000 to $125,000. Your insurer sets the surrender value by formula with nothing bidding against it. On the open market, several buyers price the same policy against your age, your health, and the premiums they would keep paying, and then they compete for it. Running that competition is what a broker does for you, the seller. In 2025, the Life Insurance Settlement Association reported an average payout of $212,066 against a $24,360 average surrender value across 2,955 completed sales. Individual results vary. Here's the part most people get wrong. In most states, nothing requires your insurance company to mention the sale option before it processes a surrender. A few states do, including Washington, Wisconsin, Oregon, Maine, Kentucky, and New Hampshire. Everywhere else, the comparison is on you, and the order matters because a surrender is a one-way door. Once the policy is canceled, there is nothing left to sell, and no buyer can pay you for coverage that no longer exists. Checking the market first takes nothing off the table. If the offers come in low, or none come at all, surrendering is still there. The surrender value is the floor, not the price. Taxes are where the two really separate. When you surrender, every dollar of gain above the premiums you paid is ordinary income, taxed at the same rate as your wages. When you sell, federal law splits the payment into 3 parts. Your premiums come back tax-free. The amount from there up to your cash surrender value is ordinary income, and anything above that is a long-term capital gain, usually taxed at a lower rate. One more thing. If you have borrowed against the policy, the loan and its interest come out of your surrender check, and the taxable gain can be larger than the check itself. Have a tax professional run your own numbers first. To be fair, surrendering is sometimes the right call. If you need the money quickly, most surrenders pay out in about 2 to 4 weeks, while a settlement takes 60 to 90 days. If the policy does not qualify, and buyers generally want a death benefit of at least $100,000 from an insured who is 65 or older, surrendering may be the only way to get cash out. On some smaller whole life policies with high cash value, the two numbers land close enough that the simpler path wins. And if your family still needs the coverage and the premiums are manageable, keeping the policy beats both. What you should not do is guess. Get the market value first, then choose. Citizens Life Group put this explainer together. If you want a number for your own policy, the estimate link is in the description. There is no upfront cost.